Hi guys, Stanley here. I'm the co-founder of valueinvestasia.com, an investment portal where we give you investment news and also in-depth analysis on listed company every single week. So if you're new to this channel, remember to hit that subscribe button so you'll not miss out on any of our videos. So far, I have been sharing my investment journey online for more than 5 years. And the main asset that I invest in is still in stocks, as I do feel that the stock market is the best way for us to build wealth in the long term. But of course, this year has not really been great for me or for most equity investors. However, the volatility in the market is something investors have to accept as a risk if we want to be in the market. In fact, investors who expect only to make money in the stock market are often the most dangerous ones. Because there are basically two types of investors. Those who know that there are things that we do not know and will never be able to be sure of, and those who do not know that they do not know. So the key in investing is not to avoid all losses, but rather know how to avoid permanent losses and minimize our losses when an investment turns bad. And because when we think that we can avoid all losses and capture all the short-term gain, we end up believing that we can time the market. And the more that we think that we can time the market, the more we will trade. More often than not, the more we trade, the more mistake we end up making. So most successful investors have actually made their wealth not from timing the market, but rather from just staying in the market long enough. And this is because in general, the stock market still heads uphill in the long run. And if we can minimize our permanent losses with the mistake that we're making in the stock market, we can save more money for the future. And that saving can compound itself over time. For example, a few dollars saved today could be worth hundreds in the future. But the catch is, what is considered a mistake? This question is really tricky because investing is a game that involves both skills and luck. And in a game like this, we can play the game perfectly but still end up unlucky and lose money. And on the contrary, we can also make blunders and still go off with a profit. So the main problem here is that most people, including myself, tend to overestimate our skills and underestimate our luck. For example, whenever I make money from an investment, my first reaction will be, I'm a genius and totally I nailed that investment. And whenever I lost money in a trade, my brain automatically will shoot up, I was being very unlucky. However, that reaction can be very misleading and not productive if we are trying to become better investors. One of the best books that I find touching on this subject is by a professional poker player named Annie Duke. And the book is Thinking in Bets. Annie is actually quite a character. She's a graduate from Columbia University and went on to do a doctorate coursework in cognitive psychology. Yet when she came out into society, she decided that she wanted to become a professional poker player. So imagine telling that to your parents after getting a doctorate. But of course, it worked out for her as she collected more than $4 million in winnings throughout her career. And for those of us who might not be familiar with the game of poker, it is a game that involves both skill and luck as well. So unlike a game like chess, where you have complete information about the game of where your opponent and their pieces are and the movement of each pieces and the size of the board and whose turn is it. But in poker and also in investing, we have to make decisions when we do not know the complete information. Sometimes we might not know our opponent's cards and what their bets will be. Thus, in this world of imperfect information, Annie Duke basically spelled out how we should approach decision making when it comes to playing poker. So here's an example on how I adapted her strategy into the game of investing. But before we continue, I'd like to thank our sponsor for this video, Seeking Alpha. Seeking Alpha is the largest investment community in the world, and it provides investors with a wealth of information through their database, their news, earning transcript, and also crowdsourced analysis. Both personal and professional investors has really find great investing ideas through Seeking Alpha. I myself find it extremely useful to keep up to date with companies that I'm interested in. So right now you can sign up for Seeking Alpha today for more than a 50% discount from their premium membership. So If you want to find out more, remember to check out the link in our show notes below. Now let's get back to the video. Firstly, we have to realize that we will never know everything about a company, and we can never be certain that an investment will do great, no matter how confident that we can be. For example, if you ask me how confident I am in my investment in the company Tencent's holding 5 years ago, I would gauge it around maybe 70% confidence level. It means that in my mind, I do feel that Tencent have a good chance of growing and become a much larger company than before. However, 5 years down the road, Tencent has hit some roadblocks and the growth was not as rosy as it once was. But does that mean that I have made a mistake? Well, the key is to accept that although I'm optimistic about the company, there will still be some probability that things will not work out as I expected. And so when we're making our investment decision, we must know that we can never assume that our thinking and expectation is the only path for the company. If we invest as if that we are certain of everything, we might be heading down a dangerous road in our portfolio. Hubris is the worst enemy of an investor. So we have to accept that we do not know everything. And that's why we diversify our portfolio. By hedging our bets in our portfolio with multiple stocks, we're saying that we know we will make mistakes along the way and lose money in some of the stocks we invest. But if we see our portfolio as a whole, we will win some and lose some. And as long as our overall portfolio is doing alright, then we are okay. We do not need to be right in every single stock that we invest in. We have to start thinking in bets. And investing is a game of probability. After that, the second part is to really analyze our mistake to make sure that we do not repeat them. For example, for me, I have no shortage of mistakes throughout my investing journey. I'll share with you a few of them today. One of them is GoPro. I really bought into GoPro thinking that they could be more than just an action camera brand. I thought that it could be a premium brand that all things action related, and I got sucked into the management story of monetizing video content. And fast forward to today, basically nothing really happened. The company is still pretty much a hardware business and was not able to diversify the product range into other camera hardware as well, such as drone. So basically, their content business went nowhere as well. I made the mistake of not really waiting to see some tangible result before I invest. And I also learned that I can easily have waited to see how their content and drone business really went before investing. So it is important for me that in the next investment, I do not rush into an idea, because that rushing into GoPro cost me 95% of my capital in that investment. It is really a mistake where I make the wrong bet and also lose money in it. And there are also other memorable mistakes. One of them is Green Packet, a listed telecommunication company in Malaysia. This is when I first started out investing. I mostly invested in the Malaysian market. And at that time, I invested in a company called Green Packet. And I was so optimistic about the company when it rolled out its WiMAX internet. This is because Green Packet was just one of 4 companies that was approved by the government to roll out WiMAX infrastructure and providing internet services to the Malaysian public. At the time, I thought that the long monopoly held by Telekom Malaysia is finally coming to an end and Malaysians could finally be enjoying better internet services. So at the time, I thought that Green Packet was really a no-brainer investment since the service of the incumbent was far from perfect. Yet, I couldn't be more wrong. And in this case, I made a mistake, but I still profited from it. And this is because after 6 months of buying into the company, the stock price shot up and I ended up just selling it for a 50% gain. And at that time, I really thought that I have made a great investment and I see myself as a genius. It was only 2 to 3 years later, seeing how Green Packet was still burning money from the business and never really making a dent on the incumbent business. And today, Malaysians do enjoy relatively better internet, but it is still provided by Telekom Malaysia. So this is a clear investment mistake on my part, and I still profited from it. Therefore, you see, our mistake has no correlation on whether we made or lost money in that stock. And you can see that it actually took me a few years before I truly understand if I have made a mistake on some of the past investment. So from that point onwards, I really try to incorporate more control into my investment process so that I could easily review and try to separate out where is my skill coming from and where is my luck playing. Some strategy that I am using, and maybe you'll find it useful as well, are the following. Number one, don't rush into buying a company. Instead, keep them in the watch list and monitor them for a while. Now I like to keep a record on why I'm buying a stock. For example, I like to write down my main thesis on why I like a company and my expectation of that company after investing in them. In this way, I can easily review the investment over time to see if the company is really progressing above or below my expectation. Lastly, before investing, I like to think about what are some of the possibilities that my expectation will become true and what are the alternatives that would happen. This is important for me to think about how to size up my investment for that particular stock. If I feel that there are just too many unknowns in a company, I would most likely bet a smaller amount into it. So there you have it. These are just some of my thoughts about how to keep my portfolio as safe as possible. I thank you for following me on my journey here to build up my portfolio. And I can promise you that along the way, I will still continue to make more mistakes. And I hope to share them as much as I can with you. Anyway, if you have gotten value from this video, please give us a like and share it with a friend who you might think will benefit from it as well. And of course, do check out our sponsor, Seeking Alpha, on how they can help you in your investing journey. You can support our channel by supporting them. So remember to click on their link below to enjoy a 50% discount from your membership. Anyway, as always, my name is Stanley. Till we meet again, invest safely.